The largest gold producer in the world smashes earnings yesterday and the stock sells off big time today. What in the world is going on? It's no secret you want to hold precious metals during times of inflation. We've seen it in the past, especially in the decade of the 1970s when gold was a monumental performer. Here's the data there. When inflation is up 3% or higher in the years to follow, you can expect good returns from gold and silver. And we've got the perfect environment right now. Rates are coming down, inflation is still elevated. This is a time when gold should be performing. So what is ahead? Let's look at Don Durrett from goldstockdata.com. With gold at 3,000, this was back from February when Newmont was at $34. So if you bought then, not a bad return, not bad at all. He's got $170 as the price target with gold at 3,000. And he's making a few assumptions here. The production capacity, the break-even costs for a production of an ounce of gold, their free cash flow, and their free cash flow multiple. So he's assuming that there will be interest pouring back into the sector. This could be from tech rolling over or economic weakness or geopolitical uncertainty. So he's making some assumptions there. But hey, that's quite a target. And by the way, he specified under this post 2 or 3 years is his timeline for that. Now, the results for Newmont, you see these mega beat numbers, 72 cents earnings per share, beating the 53 cent estimate, 4.4 billion with a B, surpassing the 3.49. But inflation's coming down, so we know their input costs should be decreasing, and the spot price of gold has been ramping. So it was expected that they were going to have a great quarter. And there were some things underneath the hood that did not impress. So let's take a look. But before we do, just to get things in perspective here, look at the chart. Since February, or around the time when Don made his call, we've got quite an uptrend here. This shooting star doji on the charts looking like indecision here around $45, $46. But we could come down a little bit further, even to 43, 44, and bounce here and still maintain this trend. We do see the MACD crossing over a bearish pattern here. We see the RSI trailing off, so not the best. And anytime you're down 4% after a smash beat quarter, not the best, but we got to zoom out here and see really what's going on. Now, looking at the daily on the EMAs here, we did see the 100 cross over the 200, and we're losing the 8, 14, and 20 here. So again, not ideal, but we've got the 50-day right here, which is going to line up with that trend line support. And we still got the 100-day that crossed over the 200-day. So the trend looks intact. Now I've done some drawings here. This is GDX, the senior gold miners, going back all the way to after the financial crash from 08-09 when things ramped. And then look at this mega cup we're forming. We could get this cup handle breakout up here. What's that going to look like? Maybe we come up here, maybe we eventually see some weakness. People get bored again and we ramp. So let's see. But also, if you just look at this trend line we've got here, you can even push this back all the way to the top here. And, we're taking some liberties with how we're drawing that, but that's a breakout in my book. So let's see if we can keep the momentum there. Now, Newmont stock specifically, let's take a look at, this is just from Morningstar, fair value estimate of $52, a 4-star ranking, so still perceived as being undervalued. The world's largest gold miner portfolio reflecting 3 major deals in recent years. Not a ton to look at here. Let's try and find something that's a little bit more interesting. So we can look at how it compares to the competitors, Agnico, Barrick. They look to be similarly, well, Agnico, they have as being overvalued, as a matter of fact. Barrick in a similar spot, and Kinross, they've got some, so they're overvalued as well, according to Morningstar. I don't know. I would rather go with someone who's more specifically in the commodity space and in the mining space and in the precious metal space. Morningstar is a little bit more well known for their equity research, so hard to really say. But then just looking at the bear argument, bigger is not always better in gold mining. It's true. There's a lot of regulatory risk. A lot of different stuff can happen that can throw things off. Let's keep going. I don't want to get bogged down with this sort of stuff. Risk and uncertainty, risk rating of medium, cyclical gold prices, operating leverage, cost of capital. They have some stuff about how their capital allocation is not great, or just standard. And we've seen in the past that the management group has been, I wouldn't say incompetent, but has not been able to deliver quite what they've been supposed to. And you can see this reflected in the share price. The stock's basically gone nowhere in decades. But let's see, there's one other thing I wanted to look at here, if I could find it really quick. But of course, I'm not going to be able to. And that was going to be, yeah, okay, so we're back on the chart here. Yeah, this one. Okay, I think this is really what it comes down to, about the cost inflation. They've got this all-in sustaining cost on an ounce of gold is going up, just about matching or perhaps even outpacing the increase in the spot price of gold. So what you're looking for with a miner is leverage to the spot price, meaning for every couple of bucks the gold price goes up, you can see double or triple the gain in the miner. And that's not going to be the case when their sustaining costs keep rising. It's just the way it is. So even though they had this pretty decent quarter, all the metals and minerals and different items they've been able to pull out of the ground, they're still trailing off a little bit here from the end of 2023 in terms of their production capacity. So we're seeing costs go up, production capabilities go down, and it's just giving people some pause. You know, I mean, why wouldn't it? And then let's just look here. So this is another thing that's giving investors pause right now. This was their all-in sustaining cost, 1,562 in the second quarter, and they've guided for 1,500 being their full year all-in sustaining cost, and the street might just not believe them. What are they going to be doing to bring the cost down to produce their gold? So basically what the street is saying is, unless gold keeps going up, this all-in sustaining cost is going to outpace the growth of the spot price, and we don't trust you. So we're at a little bit of an equilibrium here, and this is how you get a scenario where you have this mega smash double beat. Gold is ramping, and all the scenarios are right in terms of the macroeconomics and monetary policy. The stars are aligning, but it could just be the case that the street isn't particularly impressed with Newmont's ability to execute. But all that will be for naught if the price of gold keeps ramping. And if we end up going to 3,000 or higher, it's just not even going to matter. Wall Street's going to get excited. Retail investors are going to start pouring capital in, and there's a lot of catalysts there. So I think having some exposure to metals and metals miners is a good idea, particularly in an environment where holding bonds it's a challenging trade to put on with the inflationary dynamic. So, hey, that's just a little bit of riff from me. What do you guys think? Let me know. Take care.